Welcome to the Deep Dive, where we take the crucial financial narratives buried inside earnings calls and really extract what you need to know. Today, we're tackling Miami International Holdings, Inc. That's MIAX. This is their Q3 2025 earnings call, and it's a big one. Their very first as a public company after that August IPO.
That's right. And our goal today is really to get past just the headlines. We need to break down the operational wins, sure, but maybe more importantly, understand how they use that IPO money. They basically transformed the company, de-risked the whole thing, and now they've laid out this pretty ambitious growth plan across multiple assets, and you can tell it's working already. The stock reacted really positively after hours. Investors seem confident.
Okay, so let's start there with the big picture. Because you're right, the numbers looked, well, contradictory this quarter. You had amazing operations, but the main GAAP number showed this huge loss. How do we square that?
Yeah, the classic adjusted versus GAAP situation, wasn't it? I mean, on paper, they reported a GAAP diluted loss of, what was it, $1.46 a share? But look, this wasn't about the business falling apart. It was strategic. It was a cleanup. That loss was almost entirely down to non-recurring stuff, paying off that $178.4 million in senior secured debt, plus, IPO costs.
Right. Okay, that makes sense. But those headline numbers, they grab attention. How did the market see through that big debt write-down? How did they focus on the actual performance?
Well, because the underlying operational numbers were just too strong to ignore. Net revenue, for instance, hit a record, $109.5 million. That's up a massive 57% year over year. And it beat the consensus, too, which was around $107.1 million. But here's the real story the number of people focus on. Non-GAAP adjusted EPS. It came in at $0.42. The consensus was $0.30, so that's a 40% beat. Huge. It just shows they did exactly what they said they'd do at the IPO. Raise cash, kill the debt, and grow the operation immediately.
That kind of execution, especially right after an IPO, yeah, that definitely warrants a closer look. Let's unpack that operational engine. It seems like it's really firing on all cylinders. What drove that 40% EPS beat specifically?
You got to look at the efficiency. Adjusted EBITDA just soared. $48.0 million. That's up 157% year over year. But the metric that really jumps out is the adjusted EBITDA margin, 44%.
Wow, 44%. What was it before?
It was 27% in the same period last year. So that's a huge leap.
Yeah.
This is what management's talking about when they call MIAX a technology-first exchange.
Yeah.
They made those big tech investments up front, and now you're seeing the payoff. They can scale at volume without the cost scaling nearly as much. Pure efficiency gain.
Okay, let's break it down by segment then. Options is obviously the powerhouse here. What are the key metrics showing?
Yeah, options net revenue was $94.5 million. That's a 55% jump year over year. And volume, the average daily volume or ADV, that grew 56% to 9.6 million contracts a day. But the narrative that's really catching on is market share. MIAX Exchange Group hit a record 17.2% share for the whole quarter.
And it didn't stop there, did it?
No, that's the fascinating part. Management pointed out the momentum actually picked up. They hit 19.4% share in October. I mean, think about that. Against the big established players, those are serious sustained gains. Really impressive.
Okay, options are clearly booming. Let's shift gears a bit.
Right.
What about the newer revenue streams? International looked like a total blowout number.
Oh, it was. International net revenue jumped to $5.5 million. That's up, get this, 586% year over year.
586%? Where did that come from?
Almost entirely from the acquisition of TISE, the International Stock Exchange, back in June. And it's not just top-line growth either. Management made a point of saying that segment is now making positive operating income. So the integration seems to be working, and fast.
Right. Validates the M&A strategy there. What about the, let's say, less mature parts, like equities and futures? Any weak spots?
Equities revenue looked pretty healthy, up 95% to $4.4 million. Management's focus there seems less on just grabbing volume and more on the capture rate, how much they earn per trade, trying to push it towards break even. Futures, though, did see a little dip. Net revenue was down 9% to $4.8 million.
Why the dip in futures? Anything structural?
They mentioned two things. One was just lower volatility in some specific commodity markets, like hard red spring wheat, less trading activity there. And the other was some volume migration. Traders were moving over to their new tech platform, Onyx.
Okay. So maybe a short-term dip for a long-term gain with the Onyx platform.
Exactly. It might look like a small headwind now, but shifting to Onyx is absolutely crucial for their big strategic push into financial futures next year.
Which brings us nicely to the balance sheet transformation, that debt repayment. Just explain the impact of that. How does paying off nearly $180 million in debt change things for an exchange?
Oh, it's night and day. They went from being, a growth company with significant leverage to basically a cash fortress almost overnight. The IPO raised nearly $397 million gross. They immediately used the chunk needed to pay off that whole senior secured loan. So end of Q3, their cash balance was $401.5 million. Total debt, just $6.5 million.
Wow.
Yeah. So this de-risking, it's not just good housekeeping, it's a strategic weapon now. They've got this huge amount of cash and a super clean balance sheet to go after growth aggressively.
And the CEO, Tom Gallagher, he kept emphasizing their tech resilience. He used that phrase, building for Easter Sunday level stress, like the absolute peak volatility. Why is that important beyond just keeping the lights on?
Well, it's not just bragging about uptime. It connects back to those margins we talked about.
Yeah.
Because they built these low latency systems that can handle massive spikes in volume, they don't need huge new capital outlays every time volume grows. That foundational tech strength is what lets them confidently launch these big new initiatives they talked about.
Right, the catalysts. Let's get into those. What are the major strategic moves they announced?
Okay, two main things stand out. First, they're expanding physically. In September, they launched the MIAX Sapphire options trading floor down in Miami.
A new trading floor in this day and age.
Yeah, it's pretty notable. Only the second new open outcry floor opened in decades, apparently. It gives them a physical presence to complement their electronic exchanges.
Interesting. But the really big pivot seems to be taking that clean balance sheet and that Onyx tech and going straight after financial futures, right?
Exactly. That's the main event, I think. They plan to list financial futures on their MIAX Futures Onyx platform starting Q1 2026. They're kicking off with Bloomberg 500 Index futures, then the Bloomberg 100 Index. But it's not just about listing new products, it's how they're doing it. The key is that these products will clear at the Options Clearing Corporation, the OCC.
Okay, why does clearing at the OCC matter so much to traders?
Because it's a massive incentive for firms already heavy in options, which is MIAX's core base. Clearing through the OCC lets members cross-margin their existing options books against these new MIAX futures positions.
Meaning they need less collateral overall.
Precisely. It ties up significantly less capital for them, makes it way more efficient and cheaper for their existing options members to start trading futures on MIAX instead of somewhere else. It's a direct competitive play against the established futures exchanges.
Clever. And beyond those launches, they hinted at more innovation, things that sound, well, very current.
Yeah, they're clearly watching regulatory trends very closely. Management confirmed they're actively exploring event-based contracts. Contracts based on economic data releases, political outcomes, maybe even sports results. And importantly, they said they're ready to list single stock, zero-day options, zero DTEs, basically as soon as regulators give the green light. They stress the tech stack is built for it. They're just waiting on approval.
So putting it all together for investors, the market's clearly buying this story. The stock's performance has been pretty incredible since the IPO.
Oh, absolutely. Since mid-August, the stock's up around 64%. It has just crushed both the S&P 500 and the financial sector ETF XLF over that short time. And the backdrop helps, right? U.S. options ADV hit 56 million contracts in Q3. That's driven by things like more retail trading, plus institutions using options for risk management. Management thinks that underlying trend continues, especially with all the global volatility we keep seeing.
And the market's reaction right after the call seemed to back that up.
Definitely. Trading volume in the stock jumped like 2.4 times the average the day after the call. That shows real follow-through interest, strong conviction. And if you look at the options market on MIAX stock itself, the put-call ratio is about 0.73. That's pretty low, indicating a bullish bias. People aren't rushing to hedge, they're positioning for more upside.
Okay, one last point on the financials before we get to our speculative bit. Expenses. They're building out a lot, so costs are up. But did the CFO give any hints about future margins?
Yes, that was an important signal. While operating expenses definitely rose, hiring people, building out the Sapphire floor, the CFO specifically mentioned the major build-outs, Sapphire and the Onyx Futures platform, are mostly done.
So the heavy lifting on CapEx might be easing?
That's the implication. It suggests the rate of expense growth should slow down going forward, which, if that record top line keeps growing, provides even more support for margins to expand further.
All right, time for our favorite segment where we push the boundaries of plausibility a bit. Just a thought experiment, remember? Definitely not financial advice.
Okay, let's play. So the core idea here revolves around that balance sheet and their speed. MIAX has, $400 million in cash, practically no debt. They have this top-tier tech stack. And crucially, They just prove they can buy something TISE and integrate it really quickly and successfully.
Okay, so you have the cash, the tech, the proven integration skill. What's the outrageous but maybe plausible trade idea you're pitching?
The trade is basically go long MIX, but betting specifically on an acceleration of their multi-asset plan through a big synergistic acquisition. The hypothesis is, given the cash, the TON success, they don't wait for organic futures growth. They make a major M&A move, maybe a complementary European exchange, maybe something in data, and announce it before that Q1 2026 futures launch.
Whoa, that's bold. Betting on M&A integration speed, merging exchanges is complex, regulatory hurdles. Why would they rush an acquisition instead of just letting the futures plan play out?
Because organic growth in a crowded market like futures takes time. You have to plant seeds. They just showed they value speed by paying down debt instantly. They need to diversify earnings now while the options market is so strong for them. An acquisition is the absolute fastest way to bolt on meaningful diversified revenue using that $400 million cash pile before something changes.
Okay, I see the logic, however aggressive. How would you structure that trade then, considering that bullish tilt you mentioned in the options market?
You'd go long MIAX shares.
Yeah.
Right. But to maybe juice the return or lower the cost basis, you'd simultaneously sell some short-dated, slightly out-of-the-money puts. You capitalize on that low put-call ratio, meaning put premiums are relatively okay to collect. So you collect premium now, which helps pay for the stock. And if there's some weird negative reaction to M&A news and the stock bips, you've effectively set a lower potential entry price via the puts you sold. So wrapping this up, MIAX absolutely delivered in its first public quarter. They proved the tech-driven growth story, especially in option share gains, and they radically cleaned up the balance sheet. They're armed and ready now.
Right, and they're set to make a really aggressive move into financial futures next year, playing that OCC clearing card. So the key question left for you, the listener, to think about is this. Options volumes across the industry are really high right now, and MIAX is taking impressive share. Can they keep up that incredible pace of share gains and successfully diversify into futures and international markets before those strong tailwinds in the options market eventually, inevitably, start to ease off?
And just remember, the deep dive provides information and analysis. It's not investment advice. Always do your own homework, read the filings, and talk to a qualified financial professional before making any decisions.
Thanks for tuning in to this deep dive.